already. We're past tax day. They're winning a bunch of money. You probably, you, uh, what are you going to do? Um, and I am Tim Quast from Market Structure Edge. With me, I'm kind of almost not in the shot there. That's better. With me is Brian Wilson, market strategist, and who is much better at trading volatility than I am. Maybe he'll talk about that. So we're going to do what we do every week here, which is we give you our own experiences. We each have 4 or 5 things that we want to cover, and interrupt us at any point, and we'll address whatever you got. But I'm going to turn it over to Brian Wilson because I went first last time. So Brian Wilson, over to you.
Thank you, Tim. Good to see everyone. Tim and I really appreciate you guys coming to the demos. As Tim mentioned, please ask us any questions that you might have. Just hit us up in the chat room or raise your hand. We can stop the meeting. That's more important than anything that we might be going through. I do have five or six topics before I get started. And Tim's familiar with this. I live in Colorado Springs. Tim's up in the Denver area. Very much springtime in the Rockies today. I'm in a short sleeve shirt. 70 degrees here today. It'll be 32, 33, and snowing tomorrow. So that's very typical for this.
We're ready for it to be warm.
Right, exactly. You and my wife both. Well, let me go ahead and get started. And I almost forgot this topic. I promised that I would bring it up for one of our clients. I wanted to talk about the trade desk. This was a ticker that was given to me a few days ago. And the topic was, can you just talk about this in terms of, being a potential good entry point? And this is a good example of, what would you potentially be looking at for entry points in securities? So if we look at this, and this is the baseline that comes up, I'll back this up just a little bit more here in just a moment. We're getting some good indicators right now. We're getting sentiment that is rising from oversold conditions. And you can see when there's been a rough stretch, sentiment will sometimes get washed out for a period of time. It's always better to let sentiment start rising a little bit before potentially moving into a position or adding to a position. Short volumes are very low. So from a sentiment and short volume perspective, it's a pretty good entry point. Now, if you were looking to be a little bit safer, this would be more of a value entry point here because you're entering below 5. If you were looking to be a little bit safer in your entry, well, you would wait until it gets above neutral. That'd be a little bit safer entry point. Let's back this one up just a little bit. I haven't even looked at this yet, but it might be a good indicator. So, in fact, I'll back it up a little bit more. We saw something similar in a lot of equities. So here's the normal rhythm for a lot of equities. You'll hit 10, in this case, a pretty good demand in TTD. You'll hit 10, you go back to neutral, hit 10, go back to neutral. It's the normal rhythm of the market. And just as a reminder, this green indicator, that's what we call sentiment or demand. Just think of that as our algorithm for demand. Down below, of course, is short volume. So note what happened in November, December. Well, demand fell off the map. We were no longer hitting 10s. What happened to share price? Share price fell off the map as well. And even the last time when sentiment rose, it didn't get to 10 again. So there's been a little bit of a shift in the overall dynamic here for the trade desk. I have no idea what's going to happen for this sentiment rise. Do we get back to 10 again? Or is this kind of telling that we've lost some demand for shares? I'm not sure, but that's kind of what I would be looking at. If you like it as a value play, yes, it's a good entry opportunity. Just recognize that this opportunity might not be the same as as what we saw back in this stretch. The second area that I wanted to talk through, and I'll bring up our daily trading ideas, and I'll just call it trading in your comfort zone. And I think each one of us has different things that we're pretty good at. Tim mentioned volatility. I'm getting better at trading volatility, and often when I do, they can be pretty sizable gains. I'm not bragging. It's just I'm trading leveraged instruments. That's why some of those gains are pretty good. What I'm not good at what Tim is good at. And it's very telling. Sometimes we can have strengths that, it can be a weakness for other people. Tim can set up hedges during the course of a trading day. He's like, oh, based on the trading data, let me go to a different one right now. Let me go to broad market sentiment. So, Tim might look at this as it's going below oversold conditions. He's like, oh, shorts are getting covered. We're oversold. I think the market, should be ready for some type of rally here. And he might set up an overnight trade where he's tilted a little bit long for that particular trade, but he sets up a hedge. I'm not good at setting up hedges. I've tried it. I just end up losing money on both sides of the trade. So that being said, I'm trying to stick to what I'm good at. I'm good at let's call it swing trading on a short-term basis. I'm good at the daily trading ideas, and I'll leave the short-term hedges to the resident expert in the room. The daily trading ideas, just as a reminder, and I think Tim's going to bring this up as an example. There's not very many right now. Obviously, one in momentum, one in low volatility. And what you're just looking for is you're looking for those entry lows and entry highs, looking for 1% in your low volatility trades, and looking for 2%. Sometimes it can be a little bit more based off the volatility in a given name for those momentum names. So that was the first topic I wanted to cover. The second topic is I'll show you my screen, my watch list. This was my watch list yesterday. I haven't updated it yet today. Look at UNH. A good reminder for all of us. That was one of our momentum names yesterday, down 23% today. Of course, why is it down 23%? Because of earnings. So we're coming into earnings season. Just be really aware of that. This doesn't happen very often, but it can happen. And you don't want to get caught off guard by sitting on a 23% loser. So just fair warning, just take a look at which companies are coming up for earnings over the next really 3 or 4 weeks before you place positions. I'm going to go through a couple of reminders. I've done this at least once. Wrong slide. Here's the right slide. This is just a trading comparison between 2020 and what we're seeing right now. There's a reason to my madness. I know 2020 is different in terms of what was happening in the market, but let me just review what we were seeing in 2020. And part of the reason that I use this comparison is what was happening at the beginning of the downturn. When we got the beginning of this downturn, which was right here, that was a 10% loss in 2 days. You had to go back to 2020 to see similar activity. So what we saw in 2020 is sentiment had to get fully oversold before we had any chance at recovery. And we went down to 1.5, 1.6, something like that. We went down quite a ways. Initially, short volumes had moved higher in the market. Before we could get full recovery, there was significant short covering. And then, of course, the Fed came. 9252051512. Then the Fed came in to the rescue, and we saw the market take off. Where are we right now? Well, we've had significant decline in terms of sentiment. We just started to move higher yesterday. So sentiment has bottomed for now, and short volumes, we're getting a little bit of short covering. It's hard to know what direction short volume is going. I mentioned it yesterday. We had seen one pretty good day of short covering. It went the other direction the next day. So we're getting a little bit of back and forth activity with short volume itself. Where are we in this cycle if we're comparing it to 2020? Well, in 20, look at what happened here. And this is actually covering part of what's ahead. It's kind of a sneak preview. But look at what happened with sentiment. We started to rise and then it stopped. Now, I have no idea if that's what's going to happen this time or not, but that's something that I'm going to be watching. Will we get enough of a lift from a sentiment perspective? So here's where we're at right now from sentiment. Will we go roaring past the green line again, or will we get just a little bit of a move higher and then it stops? That's something I will definitely be watching. And will we get significant short covering like we did in 2020? To tell us that it's a little bit of a market bottom. I don't know, but those are some of the things that we're watching there. One other area, and this takes us back to a couple of markets that were not great. So I'm calling this the SPY sentiment trends. And what generally happens in the market during a bull market, what you're looking at, of course, is sentiment. And for the SPY, it's almost always at 5. Recognize that when we're talking about the SPY, we're talking about a blended instrument that's incorporating both value and growth characteristics. It's uncommon for it to get above 5. It's uncommon for it to get below 5. When it does get below 5 in a bull market, it does so ever so briefly, and it's a buying opportunity, and the market takes off again. You can see the same thing happening in 2024 at 5 almost the whole year, goes below 5. It's a buying opportunity. The market takes off. Look at what was happening in a couple of the recent markets that have not been so great. 2018, more of a correction market, S&P 500 down 6.2%. We hit one, two, three, 4 times during that year. So in other words, SPY sentiment got fully washed out 4 different times. We lost 6%. Look at what happened during 2022. 1, 2, 3, 4, 5, 6 different times that SPY hit 19.4% to the downside. What are we doing so far this year? Well, SPY has hit 1, and for a fairly long period of time there in March, it's hit one sentiment 2 different times. What's our takeaway? I mean, it's not great. We don't tend to hit 1 during a market that's posting gains. If I was a betting man, we're probably going to see either a 2018 or a 2022 market where we see some type of declines in the market. Hopefully it's not like 2022, but there's certainly that possibility. With that being said, with the 2022 comparison, let me take you back there for a moment. And Tim, am I missing any questions so far? Are we good?
You've got one which backs you up to your secret sauce for trading volatility. Joe asked, what is it that you do? What is it you look for that works so well for you?
Yeah, no, that's a really good question. I'll take you to part of what I'm tracking. We'll come back to this topic here for a moment. What I'm looking at, and there's a lot of numbers and different things here, but I'm looking at SPXY and UVXY. There's different ways that you can track that. These are the 2 that I track. So think of it as buying volatility with UVXY or selling volatility with SVXY. So I'm tracking those on a daily basis to just look at their performance, because just looking at those over time, it gives you a real good idea what's happening in the market. What I'm also tracking, and I'm starting to share this with you in the desk notes, is I'm sharing the difference that we're seeing in volatility. So this is basis point difference, and I'll show you what I mean by this. So the S&P 500 has norms. This is a modern IR report. And like I said, we're starting to share the volatility trends with you. So the norms for the broad market are 2.5%. If you get way out in front of your skis with excess volatility, it tends to ride that volatility curve for a period of time. So it's kind of like a body in motion tends to stay in motion. So you'll get volatility that goes one direction, and you'll continue to see that volatility then for a period of time. At some point, it's going to revert, which it did about 4 or 5 days ago, and just the opposite occurs. And you have to think of what's happening on the other side of the trade. People get upside down in those volatility trades. The counterparties do as well. So you go one way for 3, 4, 5 days, then you go the other way for 3, 4, 5 days. What I would recommend you do if you're interested in this, just take something like this. It's really easy to do. Just track what the performance is, and then I just track S&P 500 performance during that time as well. And it just gives me a good idea, watching it just slowly over time, what volatility looks like in the market and how long markets stay volatile versus volatility going away. And I know that's a long-winded answer, but that's kind of the way that I'm tracking that. Hopefully that makes sense. Happy to unpack that a little bit more if there's further questions. What I wanted to take you back to was 2022. A couple reasons for my madness here. One is right here with sentiment. So if you look at where sentiment is, 2.3, we have to go back to 22 to see sentiment at those levels. So we're tracking sentiment that we last saw in a bear market. That's a little bit of a risk, when I'm considering broad market considerations. Let me shorten this a little bit. I think so you can see it a little bit better. The other one is what is happening from a short volume perspective. See if I can see it here. Sure, I have the right data. I have to go back a little bit further, sorry. So what I wanted to share with you was this right here. So you can see how short volume was extremely low right at the end of that run in the market. This from here to here was about a 15% move in terms of short volume. Look at the similarities from our short volume low to that peak so far. That was about a 17% move. Now, obviously, bear market, we were lower, we were higher, we were lower, we were higher. When we reached our peak, that was about the end of that bear market. We started to move higher after that. That peak was actually a 25% increase from the short volume low. I have no idea if we need to do something similar this time. For perspective, if short volume had to go 25% higher, it would be close to 56%. And Tim, I don't know about you. I'm not sure if I've ever seen a 56% short volume reading. I have no idea if it'll get there.
We haven't.
But it was
Right.
it was just interesting to me to think about that. What did the market need to do to clear out of that bear market? We had to see an extreme. And in that case, that was the extreme. And like I said, I don't know if we would need to see a similar extreme this time, but we would have short volumes up at 55, 56%, if that was the case. I think I covered everything that I wanted to do, and we can cover the kind of the what's ahead together then.
Okay, sounds good. Thank you very much, Brian. Appreciate that.
Uh-huh.
And Chris, let me come to your question right off the bat. Let me share my screen. You know, the interesting, Brian, to go look at what happened in 2018, because that was kind of like a, it was a monetary event again in like the end of January, early February of 2018, and we had those two ones on SPY. It'd be interesting to look at the supply side and see what that looks like. So, Chris, to your question about Netflix, um, ahead of earnings I think after the close. Well, let's take a quick look at this. And again, supply and demand may not tell you what will happen, and options are expiring too. That is a huge wild card. United Healthcare shouldn't be reporting earnings. Neither should Netflix. Nobody should be reporting earnings during the options expirations period because literally United Health's market cap is 20% derivatives. So the whole thing got marked to market to zero because they expire today. So if you've got all these positions and now it's all out of the money, well, what do? You're going to have to start over with the new series next week, which might be good. I mean, those are things that you can keep in mind. But from a demand supply perspective, you'd say rising demand is good news, rising supply is not. And which thing wins? Well, demand always trumps supply, but supply will mute the opportunity. You look at this and say, well, the probability is it rises because it's over the neutral point, it's over 5, and rising. But you never know. You don't know which way people are betting. Looking at it statistically, if you looked at it in the portfolio, you could look at the key behavior. It doesn't, determine the outcome. We track that kind of stuff, and active money certainly is very bullish on Netflix, as one would expect. Everybody's bullish on Netflix, but they don't determine the outcome. They're 10% of market volume at any given time. It can be higher than that. What determines the direction of equities really is passive money, and passive money doesn't like volatility. It wants the herd. So I don't know, Chris. It's always a crapshoot. to bet on earnings. To me, it's much less a crapshoot to use momentum plays. So in fact, there are several things I want to cover, and I'm going to cover something just to share with you a couple of anomalies that I had this week. It tells me that there have been some challenges behind the scenes in the plumbing of the market. Now, I'm not concerned about it. I sent a note to the folks at Virtu. No, we know all those people quite well, and 3 of them, they're all high-ranking people. One's the CEO. I said, "You guys seeing any of this?" And I shared what happened to me. I had a limit, and I don't usually, but I had a limit order in place because I had stuff to do on my SPXL long position. This was a day or two ago, and all of a sudden, at 1 p.m. Eastern time, bam, my limit got filled, and it was $2 away from the market. It's like my position was at 116, let's call it, and 116.50, and it filled at 118.85, and it just happened wham like that. And I'm looking at all the data. I don't see anything that tells me the market has moved that much. I didn't care. I mean, it's fine. I made money on that trade. I might have moved my limit up. I don't know. Probably not. But why did it happen? And I said, that move happened. It did come. By 1:30 p.m. Eastern time, the market was at 119 and change. But why did my limit order get taken out? Who did that? How did it happen? I mean, I know where those trades are. Where's it going to get executed? And that was presumably because it was a limit order at the NYSE. So anyway, it's an interest. I've tracked in thousands and thousands of trades. I've never had that happen. And I also had a partial fill reported as a complete fill in GME. I had in the entry range, I had a limit order sitting there for, call it, 1,500 shares, and I got an alert that the order had filled. So I didn't really, I'm not worried. I looked after about 10 minutes, and I went, only 34 shares filled. So this is a big problem for institutions. Professional traders will tell me I get partial fills and the market moves on me. Uh, I don't, that's fine. The problem was that the report that I got said it filled. That's just, and I submitted tickets on both those. They were both at IBKR. And I don't know that they've answered those yet. But anyway, it tells that because in over many, many thousands of trades, I've never had those things happen, that probably, as I said, when you have tremendous volatility in a market where 90% of the volume is a form of arbitrage between a basket of equities, ETFs, and the associated derivatives, that you could have some issues. And maybe you deploy some software updates to address those issues, and maybe something's not quite right. I don't know. It's just very interesting that has not happened before. And if you've had instances like that, I'd like to hear them. Be curious to hear. Now to GME. So GME, I did trade GME. I've cautioned. I've said during options expirations and earnings and periods where it is not a momentum market, is much more speculative to trade momentum securities when it's not a momentum market. And how do we know whether it is or isn't? If there are 20 stocks in the momentum portfolio, there's momentum opportunity as a general rule. We've had some strange things happen, so there could be some anomalies in the data. But generally speaking, if you have rising broad demand, declining broad supply, and a lot of choices in the momentum portfolio, it's a momentum market. When we have one like this, then you know that the odds are a little more challenging. But once again, you look at the probability in the trailing 90 days that you can make a 2% return is very high in 1 to 5 days. And I did that today. So I had 1,500 shares around 26.47 basis. And I put a limit order in at 26,999, 27, and I got limited out. So once again, it's an illustration. If you had to wait a day or two, it didn't happen, and you have to be patient with the amount of movement. It's going to move 5%. So you have to be aware of that. But the math will almost always favor you. Doesn't always, but this is how you can use the math to good effect. You have your stop far enough away that you realize I don't want to have it where I'm going to get, if it's got to be 3% or more away from your entry point, because we've got tremendous volatility in the market. And if you just don't worry about that, knowing that the math is probably on your side, and here's what I mean, the demand side is very strong. There's a lot of volatility there in the high-low close relationships in here, and supply has declined. Well, the probability is you're going to get somewhere in there a move that's going to put you into this range, and that's all you're after. Just take your 2% and be happy. Don't chase it. When you hit your 2, don't look back. And that worked. To the long short side of the trade, I want to talk about that. This I feel like I can do pretty effectively, and it takes a lot of the pressure out of it. I like to, in markets like this, if the market is down, all of the volatility of the market as demand is sliding and supply has come down, then the probability the next day is somewhere in the day you're going to get some mean reversion. So maybe you have a long short SPXE, but realize these are risky trades. Except if you have them perfectly offset, they're not. I mean, if you buy equal amounts of SPXU and SPXL, they're just going to offset each other. So I will try to bias slightly one direction or the other. The conditions will dictate that, whatever the conditions are. If you have a dip on the supply side and the market has come down, then I'm probably going to bias a little bit long, even though the general trend continues to be down, because the probability of a bit of mean reversion is higher. So then I buy 30 or 40% more of SPXL than SPXU. And the nice thing is, if the market moves on you, I'm not really worried about that at all. And it can move pretty substantially, and so today, when the market was down, I sold my short position and I sold the long position too. I don't want, I've got guests coming in today and I don't want to be worrying about it, but those things work very well. You could, very consistently produce returns, but it's predicated on understanding the big three: demand, supply, and volatility. Demand's declining, supply not great, as Brian said. This is not awesome. I can't tell you either. I look at these conditions and say, we're not out of this. And of course, we've been very consistent on that. I've said the market's very fragile. I can't emphasize enough how fragile the conditions are when you look at this. But I can know from day to day which way I will bias my trade, and always protect yourself. Don't do a leveraged long trade with no protection. You just can get run over. Always have some offset so that you're not worried about it. And you'll look at your portfolio and you go, wow, my short leg is down $1,000. Oh, but well, just wait. if your long side it is offsetting that, it doesn't really matter. And that's, that to me is a way where you can very consistently produce returns when demand, supply, and the broad market are as unstable as they are. I'll finish where I began. Trading GME works. It's just more difficult under these circumstances. Okay, let me just remind myself here really quickly. Options, expirations, and the importance of, kind of done that. Those are the big things that I wanted to cover. So, Brian, that brings us around. Any questions, comments on that? Feel free to say, Tim, I don't understand how you're doing the long short, and I can be a little more specific if you like. But otherwise, we can talk about what's
next. There's a couple questions out there, Tim. One in regards to gold. I don't know if you have any specific portfolios that track gold. If you do, maybe if you could share that.
I do.
If you don't,
it's a very small portfolio, but it's a statistical sample that will always tell me what the condition is. And so if you were trading gold, you could use this very simply. I'll click through here. And Brian, you may have a better measure for it. I mean, clearly gold's been a fabulous trade. If demand peaks and begins to decline and supply rises, maybe you don't, that's not a good time to buy gold. If supply falls and demand rises, clearly that is a good time. And all you're doing is using what everybody else knows about gold as reflected in this case, these four stocks. I think I would have bought, if had I been able to, I would have bought KGC. It was in our momentum portfolio. Royal Gold is a customer of ours on the corporate side, but these four give you a pretty good idea of what the money is doing and thinking. And it's just a gauge that you can then translate into buying the commodity. If the people, I was trading a note today with a good friend of mine in the profession who said he's in, gold, LNG, platinum, and a few other things. He says it's probably a really crowded trade, and I'm probably going to get run over. So pray for me. But it is it's a good place to be under current conditions.
Thank you. There was one other question about how you approach stop losses. If you have any specific rules.
As I said, I don't love them, but if I can't pay attention, I'm going to use them. I'm willing to take the chance that volatility presents. I will always say that. I'm going back to the point here. If you look at GME, it moves this number has come down. But if it's moving 5%, and I bought it, let's say I was able to buy it at 25.63. Boy, that would have been nice. And I think that opportunity existed, right? So then you set your stop. I mean, at least half of that. And in a volatile market where we already know that the broad market is at least 3% volatile, then you got to have a stop 3% below. So you say, well, man, I could lose 3%. Yeah, you could, but the probability is you won't, because that is all of volatility and there's a demand supply imbalance. That's how I think about it. And then take your 2%. Now, if there are better conditions, I might want more than that. I would like to take the full momentum return of 3%. In fact, I'm working on I was trading notes with our engineer on running some data on that, in a model. We've done this. We've modeled the momentum portfolio and how effective it is doing that. But that's how you have to be willing to take some risk. And this tells you how much risk you may have to take. You don't have to take 5% risk, but you probably have to take 3%. Good enough on those? Okay, so we come around to what's next. And Brian, I think you did it. I'm not sure we can add to it, but this is what I do every day. I look at my dashboard. That's going to be the first thing I see. I'm going to check, it's 2.2, so we bottomed. I'm going to click through that and look at the supply side right away and say, well, that's not declining. That's not good. Certainly, there is there's a probability, that we say that the market always rises, however briefly, when it drops below that green line. And it did, but it was brief because of options expirations. We're hitting options expirations yesterday and today. They're crammed into a short period of time. But that's what I look at. So I look at that and say, well, I'm certainly not going to shove a bunch of money into that. I can't look at that and say, that will deliver sustainable results. Plus, new options trade Monday. We've got Friday. We don't know what's going to happen Friday, Saturday, Sunday. New options trade Monday. The market has been very volatile here because it's not what everybody, all the talking heads are saying. It's about people. Trump wants to fire Jay Powell. Oh no, wait, he's walking that comment back. We may have a deal with China that and they just talk to the broad measures. The broad measures decline. Oh, he's going to fire Powell. Broad measures recover. Oh, we may have a deal with China. It's a false correlation. The reason that we've had trouble here is because of exactly what happened in here. And we said somebody got killed. I don't know if it's a counterparty, people who bought or sold volatility, but I know somebody had their shorts handed to them in this period. And it's going to show up during options expirations, and it could Monday. I mean, will there be an appetite? If there is, that'll be a very good sign. Do people come back and say, boy, the market's pretty discounted. Some people probably got washed out. I'm going to buy a basket of stock, ETF, and index options and futures when they begin trading Monday. I don't know. And of course, counterparties prepare for that, as Brian wrote in the Market Desk note today. We're going to bring product to the market with an expectation based on a statistical sampling. Goldman Sachs is going to do stuff like that of the client base. What's going to be the demand? And they're going to try to offload their risk. They're going to say, we're going to sell you volatility, or these clients are going to buy volatility, and it's from somebody else, and Goldman Sachs takes a fee for that. Well, they try to get it right, but who knows? I mean, if nobody shows up, we're going to have a terrible day on Monday. If everything got worked out, it'll be fine. And Tuesday, then, the banks will have to look at the situation and say, coming through what just expired and what we're now backing, are we square in our books? We call that Counterparty Tuesday. So Wednesday, maybe we get a pretty good look at how things are going to go. You just have to be aware of that. When you're, am I going to trade long short Monday? No, I'm not. I'm not going to set a trade at the end of the day today. I'll wait to see how that goes. Maybe the end of the day Monday, I might. If things go okay, I'm probably going to bias a long. I'll be long short, but I would bias it long if everything goes well. What if it doesn't? I'm not going to set a trade because I don't know what the consequences will be to the banks on Tuesday. So then I'll wait till Tuesday toward the end of the day and see what it looks like. That's the stuff I do. And I'll look at always look at the dashboard, whole dashboard. What are the sectors doing? I've got an AI portfolio. I don't trade it. I just look at it to see what the trend is. Airlines and cruise ship, big tech, big tech's there for everybody. Maybe we should add Broadcom to it, Brian. I've been thinking about that. I think it meets the criteria. Then the sectors, they look okay. There's recovering demand everywhere. See that? But the supply side is the problem. The supply side is moving at the same pace. And that tells you what everybody thinks. I mean, it's a great reflection of all the smart people out there who know a lot more than we do and how they're approaching the market, and they don't know either. So they're long short, right? They're doing the same thing. You could look everywhere and say, is there anything where I could say there's a good enough bias and enough size It doesn't, you go look at small caps and say, "Ooh, there's a nice demand supply divergence there." There isn't. But suppose there were. Would you pile into that? No, it's 5% of market cap. You want something material because otherwise you can just get run over. Mid caps, I keep a mid cap portfolio. It's way over 50% short. Not buying that. Natural gas, not buying that. Supply is rising faster than the demand side. I mean, it's telling me nothing more than I already know by looking at momentum and low volatility and broad sentiment. But I still do it. I'm still going to look all the way. Sorry, I refreshed it. All the way across the dashboard. Okay, so what do we think? That's what we think. Brian, I don't know. You want to add to that?
I do have a couple thoughts, Tim. Before we get to that, a couple of clients, Brad and Barry, are asking about IBKR. Are there any updates on the IBKR arrangement to have that light version of Edge?
So that's why our audience is lighter at the moment, because we're not doing anything at the moment to drive additional traffic. We're content at the moment to sit and wait, because I've been focused on portfolio performance data. We have fabulous performance data, and I'm talking to a bunch of people. We've had discussions with Fidelity and Schwab, and there are a variety of other folks in there. And I'll just see what opportunity presents itself. With IBKR, I am content at the moment to wait. I had a conversation today with Karen, my wife and business partner. Said, could we go back to them and say, hey, you make it, we're not going to give our IP away. That is a hard no to me. Not going to do it. We're not going to put our data on the platform and have people just use it for free. Why would we build it? Why would you build something that you give away? And so unless and until that position on their part changes, I'm content. We've got plenty of other things to work on, but you're going to see that. If we're not driving a bunch of people to the platform, that's why we've just kind of have this smaller group that's in these demos, and I'm okay with that for now. That's where we are.
One last question, Tim. Could you bring up your AI portfolio just so they could get a screenshot of that?
Yeah, I don't know if this is perfect. You guys are you're better at this than me. The stuff that should be in there. These are the things that I have in here. It's from Rambus AMD AI, of course, which is, who is that again? C3 AI. Google, Microsoft, NVIDIA, Palantir. I don't know. Is that a good reflection? It's a sampling that will tell me the general flavor of how people think about the sector, right? With NVIDIA sort of dominating it. And it's fine. There's nothing in particular wrong with it. But, you would look at it and say, where's the money? Well, again, I look at the group and say, well, I'm not buying it right now. There is that you could say there is divergence. There is that. There is that. So maybe we should.
Hey, two quick thoughts if I have time, Tim, if that's all right.
Fire away.
Just in terms of the the path, potential path ahead. So minimize those. Sorry about that. And I'd mentioned this, I think, in the market desk yesterday. So what I want to show you is what was happening last August. It's always hard with comparisons because it's difficult, apples to apples type comparisons. But what happened in August, I knew the broad market sentiment was declining coming into expirations, but we were about to bottom. So I was looking in the data set, when was the last time that occurred? Declining sentiment, about to bottom at expirations. That would be right there in August. That's why I used that comparison. You can see that the market bottomed right there then, and then the market rose afterwards. Now, obviously, that was before all the tariff news, everything else. I don't know if it's applicable that or not, but that's the potential coming out of expirations, is we could get some gains because we are very oversold. So that's kind of the good news scenario. The bad news scenario would be 2020, and get the right one here. So once again, in 2020, we did start to rise from sentiment, but we went nowhere. So that's why we need to watch demand next week. And Tim mentioned that. What does demand look like coming out of expirations? If demand stops rising and quickly moves lower, well, be prepared for additional downside. So I just wanted to share with you those two kind of different sides of the coin there, just to be aware of that.
That's good. Good note to end on. Sorry, we took you a little long again. Well, this is what we do, don't we? Good to see everybody. Enjoy the long Easter weekend. There will be no note tomorrow because we're taking the day off too. Hope you guys do as well. And we will see you next week. Look forward to that. Thanks a bunch.